everyone, I'm Rashan Gidwani, the media host and presenter for Pitch Media. Welcome back to another episode of Tea Time Tuesday, our regular fireside chats with financial analysts, industry professionals, and finance experts, through which we hope to tell you about stocks you should look at, industry trends you should follow, and matters which will help you become a more savvy investor. Today, I'm interviewing Mr. Adrian Chew from CSOP Asset Management. He oversees ETF investment solutions for brokers, wealth managers, and family offices in Singapore. Adrian is also part of a team responsible for developing sales strategy and strategic partnerships with institutions in Southeast Asia. Adrian, there are several REITs-related ETFs listed on the Singapore Exchange. So why does CSOP want to create another similar ETF?
Now, that's a very good question. Now, before I answer the question, I probably have to tell you more about the index that the ETF is tracking. The index represents the most liquid REITs listed on the Singapore Exchange. Now, out of the 42 REITs listed on the Singapore Stock Exchange, the index has 28 large and mid-cap S-REITs, which has at least a free float market capitalization of 500 million Sing dollars. Now, factor backtesting shows that historically, large and mid-cap S-REITs tends to outperform the market as it's able to tap into opportunities such as reducing the cost of borrowings, the growing through acquisition, which further increase the market pool cap of the index. Now, for instance, historically, returns have shown that large and mid-cap S-REITs have better risk-return adjusted profile as compared to smaller S-REITs itself.
So what is the USP for this REIT ETF?
Right, the unique selling point is that contrary to many traditional indices where larger market capitalized constituents are assigned with higher weights, for the IHS REIT Leader Index allocates and rebalance the constituents based on the average daily traded velocity calculated over the last 6 months. So during each rebalancing exercise and liquidity enhancement is performed, where constituents within each quartile are assigned with an adjustment factor based on their respective free float market capitalization and the average traded velocity. Now, higher liquidity REITs are assigned with higher weighting, while lower liquidity REITs are assigned with lower factor adjustment. So such unique features make the index and the ETF more robust and smarter, as this rebalancing captures investors' high interest in the underlying REITs and reflect trending sector rotation within the REITs industry. So therefore, it helps investors to gain exposure into relevant sectors that better represent the market condition.
Adrian, do tell us, what are the index's sectors exposure currently?
Right. So right now, the index sector allocation breakdown is that 50% is actually into industrial REITs and data centers, and about over 20% exposure into office and retail REITs at the moment. So you could see that this is actually a very good representation of the current market situation. In terms of geographical allocation, 64% is allocated into Singapore properties, while the rest is actually distributed into Australia, United States, mainland China, Hong Kong, Japan, and even into European properties itself.
The Singapore government has announced further relaxed COVID measures from the 29th of March. Do share your views on how such moves shape the REITs landscape going forward.
Yes, so Singapore government has further relaxed measures with inbound travels restriction into Singapore will be relaxed from 1st of April, and 75% of the workforce will be allowed back into offices, right? Definitely, office, retail, and hospitality sector will benefit from the reopening story, as we have seen other countries around the regions have opened as well. If you break down into different sectors, office sectors will continue to do well as demand is outpacing supply, which has been delayed over construction delays, right? So in the first quarter of this year, Grade A offices rental were up about 2.3% quarter on quarter, the fastest pace of growth since the rental has bottomed out in the first quarter of 2021. Um, and with rents, coming about 7% year-on-year growth. Right, office rents are expected to grow strongly this year in 2022, which will benefit office REITs such as CICT, Capital REIT, and Suntec REIT. Now, next, retail, right? Retail in particular, such as suburban retails, has held up well through COVID. It's expected to see gradual growth as measures are further relaxed. For central business district, retail will benefit from the return of office by the workers. But we expect to continue to see a bit of softness in terms of Orchard Road retails as overseas visitors have not fully returned back to that area. Right, for hospitalities, hotels, while we are positive, we believe that there will be a gradual return until we reach the pre-pandemic levels. Large outbounds of countries such as China remain closed. So that was actually change. That would definitely be a game changer for the hospitality. Right, the Ukraine-Russia conflict has also impacted demand from Europe, and hence we think travel will only be fully recovered by 2024.
Now, Adrian, as you have mentioned, the iEdge S-REITs Leaders Index has about 50% allocation to industrial, logistic, and data centers. Would the reopening affect these sectors?
We believe it have very little impact in the industrial sector, so my answer would be no. The reason is that the industrial sector, particularly warehousing, is benefiting from the structural change that will play out over many more years to come. While the shift to e-commerce, we believe that it is permanent and will continue, though we are likely to see a slower growth in that sector compared during COVID period. Another trend that we see is that the increased concern among companies to create a resilient supply chain, right? And this is resulting to additional level of inventory, which increases the demand for warehousing. Now, in the high-tech space, Singapore government continue to push higher value-added manufacturing and pharma production in Singapore.
The last few years, we have faced many challenges. COVID-19 and its variants, runaway inflation has been made worse by the Russian-Ukraine conflict, and interest rate hikes. How do these situations impact Singapore REITs?
Now, an increase in rates will definitely lead to higher borrowing costs for Singapore REITs, right? And we estimated that on average, a 1% increase or 100 basis points increase in rates will probably lead about 1 to 2% decline in dividend distribution. So while interest rates may rise by 100 basis points or 1%, that refinancing profile for Singapore REITs actually well spread out over a long period, and that would definitely spread out the impact of the rate over time as well. So furthermore, the Singapore REITs have typically have about more than 50% of their interest rates hedged or fixed. So that's actually less of a concern. More importantly, the growth of the distribution, or we call it DPU, has been offset the increase of interest rates. So it's estimated that sales will be increased about 8.3% for this year, 2022, and which will be more than the offset of the impact of the rising interest rates. So despite the rise of the interest rates, right, the DPU is expected to increase by 3.8% according to Bloomberg consensus and estimates.
To all the investors out there, any final thoughts, Adrian?
Yes. So to all investors, right, yield is not the only story. If you combine all the benefits of having a portfolio of large and mid-cap Singapore REITs, offers investors the higher potential of capital appreciation. Now, according to our backtesting results over the last 5 years, the annualized total return of the iEdge S-REITs Leader Index has an outperformance against its peers. If you're looking for an established sponsors, well-diversified REITs, good scale and liquidity advantages, and looking for increasing stable yield, higher potential of capital appreciation, you may consider this ETF as one of your next choices.
All right. Thanks, Adrian. Talk again soon.
Thank you, Roshan. Sure, love to. Thank you.